panelists. Thank you all for coming in today and doing this. I know we've had this webinar now delayed twice because we kept wanting to increase the quality of it. So I'm actually delighted to see the level of work that has been done, and congratulations to everybody on this.
Thanks, Aditya. Happy to be here.
Brilliant. We'll have people join in continuously. For those who are just joining us on our LinkedIn and our YouTube streams, welcome. For those of you joining on LinkedIn, if you put your questions on the LinkedIn streaming tab, that's something I'll make sure that we are able to bring in as well. Meanwhile, if I could just call your attention to the bottom of your screen where you have a Q&A tab. This is the best place to ask all questions. This is going to be a very comprehensive webinar. And so therefore, if you have questions, please ask them immediately because we are going to go through so many modules bit by bit that we won't have time at the end to go all the way back to the beginning. So ask your questions up front. We'll try to get through as many of them. The entire point of doing this live with all of you is to answer your questions and not let it just be a recorded conversation that you can see later. With that, I think let's get started. We have most of our attendees have started trickling in. Welcome everyone to this, what I am very excited about, an amazing webinar with in association with Dhruva and Duff and Phelps. And what the teams have done is that they have tried to bring together all the aspects of an entire M&A transaction to bear. So to give you an end-to-end total view of how an M&A transaction happens in India, how the valuations are calculated, what are the tax considerations, how the transfer happens, and so on and so forth. I don't think very many people have ever done this. So I think I'm very pleased at the pioneering activity this is going to be to get through, and it's extraordinarily important because I think in a perfect world, when two companies want to buy or sell or merge, you would just quickly find a valuation using a classic method you learned in any MBA school. You would make an offer, the person would accept or reject, you'd negotiate, you'd sign a couple of pieces of paper, stuff would get transferred, and everything is hunky-dory. The reality anywhere in the world, of course, that it is never that simple. There are a lot of convenience issues that actually add value to transactions, which is very important for us to note and to understand. And even more important is that in a place like India, our entire taxation and regulatory process plays an extraordinarily robust role in what you can and cannot do. And often what we have seen is the most commercially sound transaction may not be the most highly tax optimized. Now, there is a path to follow where every business person would want to have a good governance, properly structured a transaction. And then there's always going to be this back and forth between how much tax they have to save and being optimized, as well as what is the structure that works for everybody from a long-term perspective. Now, our agenda is primarily going to cover three aspects of the M&A cycle. To start off with, of course, we have the valuation and transactions structuring. How do you arrive at a value? And we've seen some insane valuations being placed all across M&A transactions. We've seen some very surprisingly low valuations being placed. So how are these actually valued? How are the purchase prices arrived at? And how do you structure them from different perspectives? Any great M&A transaction today is normally not just a one point negotiated. What's the price? There are a lot of convenants in terms of how long the payouts are, performance, management, due diligence, and all parts which really add value to when you're bringing a transaction in. And this adds value for both sides, for the buyer and the seller. It brings down risk, it optimizes price. And particularly if there is a very large disagreement between a buyer and a seller on what that price should be, these structured convents can allow them to still sit at the table, handshake, and then see how the deal plays out over time, and then get the upside that they think they should for the deal on that date. The part B, of course, is our taxation and regulatory approvals. It's very nice to value transactions the way we'd like to value it, but the Indian government has their own thoughts on this matter. How do you actually value these in a manner that is consistent with which India has always been a very aggressive tax regime. Despite the wonderful reforms that the Modi government has made, there is a notion that the house always wins. And no matter what you do, the opinion will always come, whichever is the highest tax you have to pay. And so it's very important that when you're looking at evaluation requirements, you really have to make sure that all the boxes are checked. You can't just go on a commercial basis only, because the government might disagree. And there are different contingencies based on what is under the Income Tax Act. Then in case if it's a foreign structured transaction, there are FEMA rules, there might be RBI rules, and of course there are other regulatory approvals. And knowing this in advance, these are not complicated things, but if you take care of them in advance, if you know them in advance, then by the time you start your earlier negotiations, you sort of have those frameworks in mind. You understand how to deal with them, and so your 6 months, 1 year long negotiated transaction doesn't fall flat because it's legally impossible. And of course, then once you close a transaction, this is as important as when you started. How do you do the allocation? How shares are transferred? What are the financial reporting requirements that come in? How do you ensure the financial reports that you create are in consistency with not only what you declared under the Income Tax Act and the FEMA, but also in terms of your general stakeholders? And I think the most dangerous word in the room is always GAR, and which is a very broad interpretation, which is the general anti-avoidance rules and anti-abuse rules. And these are rules which allow anybody to look at your transaction and say that, and I'll put the layman's version of it, that if there was a way to do this transaction that made you paid higher taxes, then that's the way you should have done the transaction. Now, that obviously is a very myopic view of a business ecosystem. And so understanding GAR from day one is really helpful, because if it's a large transaction, you're going to have to argue that. And it's better to have that understanding day one rather than down the line. And this, by the way, and I'm going to now move over to the experts, is extremely important no matter how big your transaction is. Regulators, tax guys, everybody are as happy to go after a 5 lakh rupee transaction as a 5 crore, as a 500 crore, as a 5,000 crore. There is no such thing that, oh, my transaction is small, it's a very little thing. Why would anybody go through this exercise? You would be shocked and surprised that even at small levels, these things still matter. So if you're involved in any way in M&A, if you're thinking about it, this is a great a case study and a great presentation to go through. One thing I'll add, certainly under COVID-19, there is an extraordinary amount of excitement in the M&A space. You have a lot of companies which are being disrupted. There are few who are seeing that they can add great value to the ecosystem, and they're searching for companies to buy. There are a lot of companies which are under stress, who are looking to exit. We've seen a flurry of mega billion-dollar transactions that have happened in the last 6-7 months alone. More are going to be announced as people consolidate, repair their balance sheets. Obviously, there are two dates we are all looking at. One is December 2020, when a lot of companies will start having to put their provisional balance sheets if they're following the international calendar year, and of course March of next year, which really means April or May, where you're going to see a lot of companies having to acknowledge the losses, the debts, and the problems that they have. Similarly, from a strategic perspective, you're going to see a lot of companies who have seen now that have been able to take market share, they have been able to really pull forward compared to their competitors, and now have a bigger appetite to do it. The last point I'll make is the quantitative easing that is happening all across the world. There is going to be a wall of money which is going to hit M&A equity when it comes to private equity, when it comes to funding. Lending rates, even during the financial crisis, were low. Now they're rock bottom, and even rock bottom still. The world is flush with cash, and they're finding deals in order to put that cash to work. And I'm shocked to see at some of the percentages that people are happy with. I'm going to leave it at that, and I'm going to invite our esteemed panel to walk through this enlightening case study. Please.
Thanks, Aditya. And that was a beautiful sort of an introduction, perhaps covering every aspect which we would cover in this presentation. Good afternoon, everyone, and myself, Aviril Jain. I work with Duff and Phelps, and I have my colleagues Vinay as well, and Weber from Dhruva joining this session. If you look at the presentation slide, there is one top bar, red bar, which I may call it as anchor bar for today's presentation. We'll go through the modules which Aditya was referring, starting with enterprise valuation and purchase price adjustments, getting into M&A transaction structures, talking about pre-deal purchase price allocation, something which is new and interesting, getting into the pre-deal tax issues, and finally the closing phase. So this is a broad sort of a spectrum of topics we plan to cover. Let me start with the enterprise valuation. I think there's no need really to mention the significance of carrying out a proper valuation. But what I intend to, and I'm sure our participants are already aware what is valuation all about. But if I may put a bit of construct here, to talk about valuation, that would be in fact helpful for the remaining sessions as well. So when we look at these valuations, we actually look at different premises of value. And it's very important to know what premise are we talking about. Are we talking about the bottom one as is, where is basis, to something like fair value, and at the highest spectrum, synergistic value. So let me start with what is as is where is value. So as is where is value is basically the value which is for the existing use of the asset. So for example, Aditya mentioned about COVID impact. You see a lot of hotels, they were potentially running at 70% occupancy pre-COVID. Suddenly COVID happened and occupancy fell to zero because there was lockdown. And even after the lockdown got opened, the occupancies have increased perhaps to 20%, 30%. And that may not be the most feasible use of that asset at this given point of time. But if you were to actually run an analysis on an as use basis, you will still use the current data, and even with a slightly medium term sort of growth rates and target occupancies and margins, etc., you might end up with a value which may not be the best use value, because the best use value at this stage could be converting that project into perhaps a residential project or some other project which might give a higher value. So this is the concept which comes in fair value, because that's where we market participants try and price in the highest and the best use of the asset. They try and price in the market participant synergies. For example, let's say there is a consumer goods company, it's a contract manufacturer doing very well, and that's one side of example, which is done well, the consumer goods, FMCG, etc. And today, because of this upscale growth, they may want to launch their own labels, and perhaps they already have. And if you were to value such a business, that, and incorporating the impact of the new business and the new products, that might fall into the fair value part. However, if we talk about the synergistic value, Vinay, if you can remain on the previous slide, thanks. Uh, that might be a scenario where, let's say, you're looking at an international player who's had no presence in India, who's trying to enter India, and what they need is not just a good partner, but also the existing customers, existing products, existing distribution network, and that might fall into what is known as synergistic value because there'll be a lot of synergies which might get generated. Moving on, if we look at from a balance sheet perspective, the enterprise value reflects nothing but equity plus net debt, obviously on a fair value basis. And if we look on the right side of the balance sheet, it will also reflect combination, summation of all the assets on a balance sheet. So see it as a two sides of the coin, where one side is your sources of funds, your equity and net debt, and on the other side, it's actually representing all the assets which are there in the balance sheet, including the fixed assets, certain current assets, intangible assets, which may or may not be on the balance sheet, and the residual goodwill. So, this whole mapping, from moving from the cap structure to the enterprise value centrally, and then trying to see what is the implied value of the assets. One is the assets already there on the balance sheet, and the other assets, which is the implied value, which is the goodwill or the intangible assets, is really will give every sort of decision maker a holistic picture. And in this deck, that's what we'll try and do, how you can use these tools in different manners to get the best out of your M&A. Moving on, this is pretty standard. How do we carry out valuations? There are three approaches: market, income, cost. I'll quickly touch upon it, but before I touch upon it, I just wanted to mention the first check. As a specialist, what you want to do is your asset or is your business already trading in an active market? Because if it is, typically all standards and all practices believe that the trading value is the best indicator of minority interest value. Yes, there could be situations of COVID. We've dealt with cases where they were listed companies, the stock price went down by 40%, 50% when COVID hit. And suddenly we hit the March 31st timeline, right? That's when all the auditors and stakeholders come back and say, hey, do you need an impairment? Or does it mean your share prices have fallen down? Does it mean it's a permanent diminution of value? So we ended up actually advising a lot of clients at that stage that given that exceptional environment, even if it's a listed or a traded stock, one needs to look at certain other approaches as well. Similarly, there are situations where the stock is not actively traded. Perhaps it might have had a recent round of funding, and that could be a reasonable estimate. But if one needs to check whether it's an arm's length round, is a third-party investment, has a new investor entered into the company or not. All these factors help us determine which approach to be followed. And if all these benchmarks are not available, which I just spoke about, then you have to get down to the part of enterprise valuation using the approaches, which I'm just going to talk about. It's also called a level 3 value in IFRS, especially when you do not have level 1 and level 2 inputs, level 1 being your own quote and level 2 being comparable quotes.
Really, we have a question on LinkedIn, and I'm sure you'll cover this. But part of the problem that we see here is the over or the under evaluation of intellectual property, whether it's brands, patents, this, that, etc. How would that fit into these methods, or would that be something you would replicate in potential in potential revenues and incomes?
Right. So when perhaps Vinay, if you want to jump back to the slide where we had those bars, exactly this one. Thank you. Aditya, when we talk about intangible assets, you mentioned brands, trademarks, other intellectual property. Those would eventually, at a overall level, in ideal sense, form part of the total enterprise value. So when we look at total enterprise value, it should cover cash flows and benefits contributed by all the assets, including the intellectual property, including the brands and trademarks, and also from the future intangibles. Because if you look at goodwill, what does goodwill represent? Goodwill represents the going concern value. It represents future intangibles which will come in the business. So ideally speaking, all these assets, when we carry out enterprise value, should be part of it. When we specifically talk about a valuation of intellectual property, valuation of trademarks, brands, etc., what we can apply, obviously, we've not covered in detail in this deck, how do we value intangible assets, but what we typically apply is something like a variation of income approach, where we try and bifurcate the cash flows and the benefits which are associated with that intangible assets. For example, trademark, one of the most I would say commonly applied methodology is relief from royalty approach. Relief from royalty, actually, as the name suggests, it simply means since you own the trademark yourself, you don't need to license that trademark from outside. So you actually save royalty payments if you were not to own that asset. And what you try and do is project the kind of savings, royalty savings the business makes from owning the asset and present value it. So that's how there are multiple approaches to various intangibles. And perhaps towards the end of the session, if you're left with some time, we can try and cover that as well. But if you remember the second bar from the previous graph, the middle bar. So right now we are talking about valuation approaches for the middle bar, which is enterprise valuation. The standard approaches are market, income, and cost. The market approach is nothing but looking at comparable companies' multiples or comparable transactions. So for example, I was talking about that consumer goods company. Let's say I would pick up, let's say this is an unlisted consumer goods company and we are trying to value an FMCG company. I'll try and pick up multiples of trading FMCG companies. You have Godrej, Marico, Dabur, Hindustan Unilever, etc. You would look at various metrics like enterprise value by revenue multiple, EV by EBITDA multiple, and try and apply to your company. Obviously, it's not for a straightforward application. Let me caution you. Typically, you have to adjust those multiples. You have to look at in the sense of relative growth, risk and profitability, because your company might be much smaller than the listed ones. Your company could be less diversified than the listed ones. Your size might be much smaller than the listed one. So you'll have to make those adjustments to do an apples to apples comparison. Similarly, we look at guideline transactions method. The guideline transactions method, we look at transactions which have happened in the same industry. Again, look at the multiples. Coming down to the income approach, we try and look at the cash flows which the business is generating currently and in future. Typically, we may build a projection model of 5 years, 7 years, depending on the stage of maturity, and try and present value all these cash flows to the current point to give a value under the income approach. The third approach is a cost approach, which we typically don't apply for running businesses, because really, if it's a running going concern, then the value is better determined by either the cash flows or by the comparable multiples. However, in some cases, we do end up applying the adjusted NAV method, where we look at the balance sheet. Especially these are relevant for asset heavy industries, for infrastructure companies which have a lot of SPVs and there is a dividend income flowing back to the top. And we try and replace some of these assets with the fair value of assets and come up with an adjusted NAV to figure out the value of the business using cost approach. We have a small example actually with certain numbers on the next slide, and I'll request my colleague Vinay, to start with the case study.
Thanks, Avril. I welcome everyone in the audience, and at this stage, I will introduce our case study to the audience. And it's a beautiful case study. We've tried to cover a 360-degree of a transaction. We've divided we've almost tried to mimic a M&A transaction here, and we're covering the M&A transaction from the point of view of valuation and tax in 8 parts. So with that, let me introduce the part 1 of that case study and make you more familiar, make you more familiar with the buyer and target here. So company A is our acquirer, which is looking to grow in India inorganically, and it has an opportunity to acquire a company B, which is smaller in size as compared to company A. focuses on manufacturing and distribution of products in consumer industry, which is what I think Aviral mentioned in one of his examples. Because of the COVID situation, a lot of consumer, in the hygiene segment, there is a lot of demand for consumer products. So let's look at that situation where company A is looking to add more skill set and capabilities in India. And just to bring out some numbers here, company A, as I said, much larger in size, has a revenue of 2,000 crore, while company B, smaller in size, has a revenue of 300 crore. Both companies are healthy in profitability, have a reasonable asset base because they are into manufacturing. So company A has a depreciation of about 300 crore, company B has a depreciation of 50 crore. And then it has an importance in the following slides. I wanted to mention it. And again, healthy profit after tax margins. But in terms of capital structure, company A in our case study has a debt, while the target company B, is a debt-free company. And so you would imagine down below in the balance sheet of company B, which is target's balance sheet, the company B is completely funded by equity of 460 crore. And the company B in the balance sheet owns fixed assets worth 300 crore and a working capital of close to 160 crore. Now, with that context here, in a typical transaction, going back to what Aviral said, in a typical transaction process, here buyer or the company A would start evaluating what is the value of company B and what is the transaction price company A would like to really offer to company B's seller. And this is where a full-blown enterprise valuation analysis comes in, and company A really attempts to understand how best approach this situation. The company B being an unlisted going concern company, two of the most commonly applied approaches would be income and market approach. Classically, you have the guideline company method, which looks at the public trading companies multiples and the transaction multiples. So you have certain valuation parameters or benchmarks which will kind of give you a market view or pricing of the transaction that could be considered by the acquirer. On the other hand, the company A, which is the buyer, takes into account a thorough analysis using an income approach. Now, as Aviral said, there could be different levels of value when a buyer or an acquirer assesses the target's value. In a typical transaction, to maximize the value for the price the acquirer is about to pay, he would want to stick to a fair value. So in this example, say the company A carries out income approach and comes up with a range of 710 to 790 crores. And in case of market multiples, he has comparable companies approach, which gives a value of 805 to 885 crore as a range, and the transactions approach giving a range of 750 to 855 crore. Now, sticking purely to these three inputs and these three outcomes from a valuation analysis, the concluded EV could be in the range of 760 to 840 crore. Now, I just want to highlight one fact. Here, the buyer has not taken into account any synergistic portion of the value. However, the buyer does take into account in his own analysis that what could be the potential upside from the transaction upon combination of the two entities in a post-transaction scenario. But that's a value buyer would typically not like to pay to the seller, because that's something that belongs to the buyer as a value and should not be priced into the transaction. Having said that, let's make it more interesting. Now let's bring in seller's perspective. Now, as in our example, seller knows the market scenario and he understands there is a lot of demand. There's a hype demand for the products in the market. There could be certain potential business upside in a COVID situation, and therefore, given that market situation, seller has a minimum expectation of 900 crore from and seeking a valuation of 900 crore from company A. Now, like in any other transaction, there's a valuation gap of 100 crore, and let's understand how in this situation, the buyer and seller come to a point where they can agree to exchange interest in a transaction. Now, in the context of bridging valuation gaps, there are many options, but structuring purchase consideration is one of the most legitimate options. And what you can see on the screen is, upfront consideration is something that in this example, company A would not mind paying an 800 crores of upfront consideration because that mimics the fair value. However, there is a valuation gap of 100 crore, and that is where the structuring of the consideration, which is between deferred consideration or contingent consideration, could come in. So considerations, should take any shape and form, but the underlying, importance of it or the meaning of it is just a mere promise that the buyer is trying to make to the seller, that if the business performs as the seller expects to be, then he doesn't mind paying up an additional consideration in the future. So between the deferred and contingent consideration, deferred consideration is usually something which is considered when there is no definite upside that the buyer is expecting or seller has articulated, and therefore buyer is majorly or primarily expects seller to participate in the business post the transaction, stay with the business post the transaction, and make sure that the business achieves certain targets in future, and that itself is just a mere delay of payout and could be classified as a deferred consideration. On the other hand, contingent consideration could be considered when there is more definite conditions, definite milestones that the buyer is able to discuss with the seller, and the buyer and seller are able to clearly pen down that if these conditions are met, an X amount of payment can be made. And we'll get into more details through our examples later on. But is this common? Yes, these structures are very common. I'll quote two of the recent transactions. Tech Mahindra acquired Zen3, had the full spectrum of consideration structures. There was an upfront payment, there was a deferred payment, and there was also a contingent consideration linked to the performance of the target. On the other hand, GMR Airports transaction, where ADP also acquired 49% stake, had a mix of upfront consideration and a significant portion of consideration was contingent in nature, linked to a future period of almost 5 years. So interesting data points, and this is what we see in the market. So at this stage, let me bring in a colleague from Dhruva, Vaibhav, to understand if these structures are common from a tax perspective. Are there any other considerations to be looked at before company A and company B, in our case study, just goes and ventures into designing these structures? So Vaibhav, would you like to share some thoughts?
Sure, thanks, Vinay. So as Vinay rightly mentioned, earnout models are a reality in transactions these days, especially in current times, COVID times, when the dip in the valuations really is not because of any structural changes happening in a particular industry, but it is more because of the overall global economic as well as health scenario. And the good part about an earnout or a deferred stroke contingent consideration really is that it enables the seller to really get a basis to perform in the future and have an upside on the valuation. At the same time, from a buyer's perspective, it gives them more time to pay up, and also if the business pays, then only if the business performs, then only they end up paying. So in that sense, it ends up as a win-win situation for both the parties. Having said that, purely from a tax perspective, it becomes extremely critical to really understand the nuances of this entire earnout model, because there are a whole host of tax issues which come with this. The particular very pertinent issue really is, when does an earnout consideration, when does the contingent consideration get taxed? So we'll see that as we move forward. Just purely from a contingency perspective, how does really one make earnouts? How does one really structure earnouts? These are typically either linked to a financial performance of the business, which may be EBITDA linked or revenue linked, or in a number of cases, if there are businesses which entail regulatory approvals for a change in ownership or a change or a transfer of an asset, then and this happens in a lot of cases where you've got mining leases involved, where when you transfer a business, you have to get the lease transferred, the license transferred, and hence in a lot of cases, transactions like these, you really make a part of the consideration contingent upon obtaining the approval from the regulator for transfer of the mining lease or assets like this. Even in telecom industry, a telecom spectrum exchanges hands, you will need approvals. Coming to the buyer's perspective, I think so there are a number of tax and regulatory issues that one really needs to consider. Purely from a regulatory perspective, in case there are non-resident parties involved, then you need to look at the Indian Exchange Control and FEMA regulations, which prohibit a deferred consideration beyond 25%, where you can't, as per the exchange control, you really can't have a transaction where more than 25% of the total consideration is deferred, and that too for a period exceeding 18 months. So in that sense, from a regulatory perspective, this is one clear restriction that one needs to be aware of in a pre-deal scenario where we are doing a commercial negotiation with the other party, and we need to be aware that such a restriction under law exists. How do we really get past this in the event there is a commercial requirement to do that deal?
I have two questions here. First, this is regardless of who's buying, who's selling. So this applies both ways, whether an Indian company buying abroad or an abroad company buying in India.
That's right.
And second, what was the logic behind this? What was the government trying to do?
So I think what the government is trying to do here, and this is a provision which has been there for quite long. I think the issue is more around getting certainty on forex flows, because the moment you keep a transaction which is outstanding for a longer period of time, you really get a uncertainty around forex risks, who bears those risks. I think that is the intent, and the second intent really, Aditya, is that from a valuation perspective, India is not right now, we're not a freely capital convertible country. So purely from a valuation perspective, there are issues and there are restrictions around pricing. So how do you really control that pricing? Because what we are saying here is that when you keep the consideration deferred, which is up to 25% for a period not exceeding 18 months, India is not asking you to do a valuation adjustment. So imagine a scenario where there is a non-resident buying into an Indian company and is paying a consideration, and a part of that consideration is deferred. Over an 18 months period, if the valuation increases, India is not asking you to top it up. So I think that is the primary intent, that someone who is buying, he pays the fair value. We are giving you a reasonable basis to keep a part of the consideration deferred. We are alive to the entire reality of a commercial negotiation, but it has to have some encumbrances.
Fair enough, please.
Great. So now coming to tax on the buyer, I think the one important aspect really is that, and this is particularly where you've got a non-resident seller involved, where the buyer has a withholding tax obligation when it really acquires. The issue is that on the consideration which is deferred or contingent, when does the obligation to withhold tax arise for the buyer? And this is relevant because if there is a default in withholding taxes, the buyer is treated as an assessee in default, and there are interest penal consequences. We've seen the Vodafone case, classic example of a buyer's obligation on withholding taxes and how it unfolded. So that is one interesting and very critical aspect from a buyer's perspective. Moving on from a seller's perspective, I think what is important really is the nature of these earnout payments. To what do these pertain? Because that really forms the basis for taxability of these earnouts in the hands of the buyer. Now, here comes the entire issue of structuring, because your earnouts could really be structured either in the form of a compensation payment to the selling shareholder, or it could be structured in the form of a consideration paid against sale of business or sale of shares. The way it differs is from a taxability perspective, you've got both the nature of income are taxed at different rates. And hence it becomes extremely critical to really understand and structure it appropriately. Vinay, if you could just move on to the next slide. So if it is really structured as a compensation, which means it is like a salary which is payable to the seller who joins the business as, let's say, the CEO, and he's got EBITDA-based milestones to achieve, which determine his earnout consideration. If it gets paid to him as a salary or a compensation, it really gets added to his income in the form of salaries on which he pays full tax. The other spectrum of this entire earnout payment is that can we really look at paying this consideration against the sale of shares or against the business that the person has sold? And even within that, what becomes important is the year of taxability. So let us say if you sold the business in year one and you structured an earnout over the next 3 years, can the taxman come and say that, look, I will tax you for the earnout compensation no matter when you receive it. I will tax you in the year when you sold the business. Right? Now, there are several judicial precedents. There are both, precedents which are in favor or against. But the primary ratio that really has been held in all these judicial precedents is that is the consideration, is the earnout payment really contingent, and hence is it really dependent upon something happening, or is it merely deferred, where let's say it is a time-based deferral? Is it merely a deferral? I think those are the issues which really need to be established very clearly, and that becomes extremely critical when we are really structuring transactions, when we are negotiating transactions, and also how we are documenting those transactions.
Weber, can you give us some examples of conditions that have historically been seen as clearly contingent, and some which are sort of just, okay, you're saying it's contingent, but this is not really contingent?
Sure. So I think, see, that's a very subjective thing. All I would say is that.
But just some very extreme examples. So, of course, as you go into the middle, a lot of gray area, and that's where the entire, that's where you make all the money. But if there were extremely, extreme ones, extreme examples, which no reasonable person could argue against.
Sure. So I think one extreme example really is, let us say you've got a transaction where a large part of the consideration is dependent upon obtaining an approval from the government. Right? Now, obtaining this approval, someone might say that this is just a procedural approval, yet the discretion really lies with the government. Now, in those cases, there have been precedents where it has been held that the taxability will arise only when the approval comes through, because that is when the transaction is deemed to be really completed. On the other hand, instances where consideration is really just linked to, let's say, the founder who is the seller remaining in continuation with the business for the next 2 to 3 years, which is more just time-based rather than any performance-based condition, then this is more a case of a deferred consideration, where usually the taxability arises when you've sold it in the year of sale itself. Sorry, Aditya, I think you're on mute.
Oh, no, I was saying brilliant. Thank you. I think because I think part of the problem is that, and this is something which I want to sort of highlight to everybody. What should be logically correct is not necessarily regulatorily correct. And so I think that's why it pays to a little bit check on these examples, because while one might say that a reasonable person could argue what is contingent and what's not contingent, I think this is where all the precedents, all the cases, all the fights that have happened really come to fore. And this is why it's important to really make sure that these earnouts, the conditions are properly seen from that perspective. I think the last thing what we all want to do is to be hit on a tax bill for things that we will never get.
Oh, absolutely. And the other aspect about an earnout really is that in a lot of cases, earnout takes the form of equity and not cash. So, imagine a founder selling a business and joining the buyer as a co-founder who will continue to run that business. There is an upside granted to him in the form of an equity, right? Again, this is an earnout based mechanism, whether in the form of an ESOP or something else. Tax issues become extremely critical because if you structure it as an ESOP, then the day you exercise, which is when your contingency events get completed, it gets taxed again as a perquisite. Whereas if you structure it differently, like a convertible instrument, you could really convert it into a capital gains tax.
So we have a question from Aksha. Generally, we have conditions precedent to be fulfilled before sale consideration is paid. Will that qualify as an acceptable contingency? Actually, I think Weber has answered this well. It entirely depends on those conditions, whether those conditions are genuinely contingent, and whether, as per established court cases and legal cases, the government has agreed that these are actually contingent, versus things that have been argued successfully by the government, saying that no, this is not a real contingency. These things or the conditions will be met regardless. I think what Akshat also, I'm now paraphrasing or reinterpreting his questions. I think what he's also trying to ask is that if general sales conditions, have to be met before the consideration is paid, does that count for the timeline? Like, actually, it'd be great if you could give us some examples on this, but just to throw in some ideas, perhaps that he's thinking is, that they said, okay, all this is done, but once a due diligence report comes out and everything is okay, maybe 3 months from now, then we'll close, or then we'll pay the last bit, or there's this part of this business unit which you don't understand. We want to continue the rest of the transaction, but we'll pay for this part once this report or inspection or something happens. Are those considered contingent, or those are just procedural matters? Sure, and Akshat clarifies, he does mean due diligence. So, you've sort of, and maybe part and whole, like, part you said, I'll pay now, and subject to the due diligence of certain business aspects, I'll pay the rest.
Sure, Aditya. So I think, as you rightly said, the key principle really is that, is the consideration really contingent? And are you really closing the deal without meeting that condition? So to Akshat's question, I think in a lot of cases, your conditions precedent are conditions precedent to closing. And really speaking, the transaction gets taxed only when it closes. So the first point of taxation of a transaction really is at the time of closing.
But just to extend that question, let's say I were to structure a deal. You have a company with 4 business units, right? I find 3 of them very valuable. 4 is one of these complicated things that I don't quite understand. And say, look, guys, I love these 3. Let's close this deal and we'll pay for them. The 4th one, we are arguing back and forth about what the valuation, what the numbers, and we say, look, both of us don't know, but okay, we'll pay 75 crores now, 25 for each. And we'll send in a bunch of auditors and all to look at the 4th business. They'll take 3 months, 6 months to come out with a report. And if their report is that the numbers match what you're saying, then we'll pay the 25. If not, we'll pay 10. Yeah. Is that a real contingency, or it's just, hey, you're just going out to verify that's what has already been stated? It's not like something is uncertain here. It's only uncertain from the buyer's perspective.
Right. So I would say at least for the 4th business, this is contingent, because you've really not paid for the 4th business until you've done that verification and that due diligence. But for the 3 businesses, there is no contingency at all.
So we could say that if a buyer has a risk of due diligence on certain aspects of a business, that's a real contingency, because it could turn out that no, that business is actually not that valuable based on, and the reason why I raise this, everyone, is because a lot of times when when we are seeing companies which are older in India, they have a lot of brands lying around, which are older brands or perhaps not in use. And there's always a dispute on the valuation of the brands, and sort of often to run an exercise of brand valuation than intellectual property. And 90% of the deal is pretty much done without those, because they're just side brands or old brands. But if they're being transferred, there is a value to be ascribed, and no one wants to wait for the transaction to be paused until you value the last thing in the entire pot. And if you want to get that report 6 months, 7 months down the line, many people will be very happy to complete 90% of the transaction, and then wait for that last 10% to come in. And what you're saying, that's a genuine contingency usually, and that you can say, look, we valued this part, we haven't valued that part, subject to a third party evaluation, verification, due diligence. then there are a bunch of numbers that could be ascribed, and when that comes in, we'll pay.
Yeah, again, so this is completely subjective. I think in the example that you just mentioned, in the event you are acquiring the entire business along with those side brands, but trying to just defer the consideration for the side brands to a valuation, then that's not a real contingency. You've acquired the business really. It's only when you have not acquired the business, then that is where that entire contingency begins.
Fair enough. So I am what I'm sensing is there is a difference between valuating an asset versus valuating an entire business line, because you were very comfortable with the due diligence of an entire business line as a contingency, but you're not comfortable in terms of an asset.
That's right.
Because the business has been sold, now you're just squabbling over what the cost of the asset is. And there is a price on the table for that, and you're just trying to argue it down based on some valuation report you're waiting for.
That's right, Adit. I would agree with you.
Okay, so key takeaway. This is still confusing, so please check. It's worth noting. I think if you were to put a panel of 5 people here, we all might disagree. So, at the margins, please be careful. Sorry, Pepper. Please go ahead.
Great. So I think in terms of the issues, as I said, from the seller's perspective, important is to classify the nature of the earnout payments, which determines your rate of tax. And then beyond that, what is important is to really establish and at least try to establish that you pay tax only in the year when you receive the consideration. So that is important for the seller. I would now request Vinay to really take over and take us through some of the valuation approaches for the contingent consideration.
Sure, Vaibhav. Before I go into, say, valuation methods that are normally used, I want to spend a few seconds, explaining why we choose a certain methods, and for that one needs to really understand the nature of consideration, and what is intrinsic to any payout is the risk. That typically.
Did we lose Vinay for a moment there, or is it my connection?
I think we lost Vinay.
Yeah. Vinay, are you back? Yeah, brilliant. Sorry, we lost you for the last 10-15 seconds. You might have to re-go through what you just said.
Sure. Am I back now? Am I visible and audible?
Yes.
Great, no problem. I'll just take a quick recap. I was mentioning that I would love to go into the valuation methodologies that are very common and used to value purchase consideration, and they're very essential to value because on the face of it, while buyer has looked at say a purchase and a consideration which is 100 crore in our example is a gap between buyer and seller. While on the face of it, there's a gross amount of 100 crore, but does the value or fair value of that consideration is really 100 crore or something else? Now, to understand that, there are different methods to value, but before we go into the methods, what's important is to understand the nature of the consideration. And there are three kinds of risk when it comes to consideration. One is the payment risk, and second could be financial matrix related risk. And third is the risk of a structure itself in terms of how the payment will be made and over what period of time and how it will be structured. So when we look at deferred consideration, the risk primarily is of the payment risk, and essentially the seller only sees a risk of a default from a buyer in terms of the payout. So what we're dealing with here is a simple time value adjustment of the payout. And I don't think there's any market risk beyond that. And when it comes to contingent consideration, we could look at like Vaibhav also mentioned, there could be certain non-financial events linked payouts, or there could be a financial matrix linked payouts. Now, when it comes to the milestone events or non-financial based milestone events, they are again not exposed to a market risk. They are very entity specific, company specific, and therefore a scenario-based approach or more probability-based approach, depending on the facts and circumstances on the ground, will really determine the expected payout. And I'll get into some examples later on in our case study. On the other hand, the financial metric payout could have possibly all of these risks, could have financial metric risk. Obviously, we'll have a financial metric risk itself, which could be in the nature of revenue risk or a profitability risk. It could have a structure risk, which means that there could be payouts which are either capped or have a floor. And definitely there will be a payment risk more in terms of the risk of default. Now, financial metric linked payouts are normally considered or behaves more like an option or derivative. And in the current practice, it is very common to use different option pricing models or risk neutral framework in what we call to value some of these financial metric linked payouts. And two of the most common methods are, Monte Carlo simulations are run to understand the likely payout, or a binomial model is used. And the choice between these two models, largely depends on the number of variables you have. And obviously Monte Carlo simulation truly runs, many more simulations to really give much more realistic picture to the buyer in terms of what could be the likely scenario. And often Monte Carlo becomes a primary choice, and even suggested in many accounting guidances and principles as a preferred way of valuing contingent considerations. Now, let's bring the interesting part of our case study. Buyer company A, has seen there's a 100 crore gap in the valuation. Say company A and company B tries to put down or pen down certain conditions. 50% of the 100 crore amount or retention amount could be paid if company B is able to successfully get a commercial launch, or is able to successfully commercially launch a patented product which is awaiting any approval. And the remaining 50% or 50 crore could be a financial metric linked payout. It could be linked to certain revenue performances. Now let's deal with the non-financial metric link first. Like I explained, a scenario-based method.
I'm just going to pause here to just add some context. Now, I don't want to murder the case study because I know it's sort of fictitious, right? But one of the consideration is who's responsible for the execution, right? So are we assuming that the management team continues, and that's how we are able to put this, or are we talking about the intrinsic value of this patent or the execution of it?
So, Aditya, it's a good question. So here we're talking about essentially the intrinsic value of the purchase, the contingent consideration itself. Now, there are ways to manage the other situation where, whether the existing sellers will participate in the company's performance and stay on as a management going forward. There, like I said previously, a deferred consideration could be considered. A small portion of a consideration could be allocated to a deferred consideration to make sure that there's a skin in the game for the sellers to continue and make sure that he's performing, and therefore you pay out a deferred consideration. At the same time, if there are certain upsides which are more in the nature of a potential upside, something which is more probable in nature than possible in nature, those could be structured as a contingent considerations rather than a deferred consideration.
So in this current scenario which you're showing, you give that example of a patent being launched, and that
Right.
there is sort of the underlining assumption that you're putting that a reasonably good management would be able to succeed at doing this. Right, and whether it's the buyer, seller, or whatever, is that if you had reasonably good management without somebody trying to pull a magic rabbit out of the hat, if they properly execute the business plan, there is a strong chance of this being successful.
Right, and it's very circumstantial, to be honest. Aditya, depends on the paperwork, depends on how strong is. Whether the patent file is contentious in nature, whether there's any element of it being contentious, then a probability could be lower, and hence the payout could be lower. But if the management feels that no, there's a very high probability, there are no disputes expected or infringements expected in getting those patents, in those situations, the probability could be much higher. So it depends on the circumstance and how robust is the paperwork there.
Please go ahead. Thank you.
Yeah, and by the way, we do take a deep dive into taking opinions from the concerned lawyers and making sure that we do understand the legal nuances of the situation and don't base our analysis purely on somebody's representation. So we do a comprehensive diligence in that sense. So thanks for that question. But yeah, so coming back in terms of how you approach the valuation in these two conditions, as I was explaining, and I think Aditya made it simpler, and we have considered a probability of payout of 50% for the non-financial metric linked payout, based on the facts and circumstances available. Buyer could, in his best judgment, estimated an expected payout of 25 crore, assuming a 50% probability. On the other hand, like I said, the other 50% of the payout is linked to the revenue performance, and the performance is as follows. If the company B meets 380 crores revenue target in the year one or more, the entire 50 crore will be paid out. But if the actual revenue is lower than 380 crores, then a proportionate payout will take place in the ratio of an actual revenue by total target revenue. Now, in this situation, like I was trying to explain, the nature of consideration here is that it has both actually, all three of the risk. It has a payment risk by nature of risk of default. It has a structural risk. There are certain caps that are there in the revenue, and it also has a financial metric risk. Now, typically in such situation, the Monte Carlo simulation will give the best estimate of what is the most likely payout in terms of depending on what is the most likely expected revenue in the year one. And these structures, let me also bring in one more point. These structures could be far more complicated, and we've brought in a very simple example here. There could be A, revenue targets. There could be certain EBITDA targets along with the revenue targets. And in some situations, we've also seen performance conditions which are linked to the value of the company. Say the company meets the revenue target, but for some other reasons, the value of the company is eroding going forward. So what the buyer wants to make sure that, while performance metric is fine, but what I really want to make sure that the overall company value grows after the acquisition, and hence the payout should be linked to the value. So some of those structures could are much more suited for Monte Carlo simulations and are best estimated using this model. So to sum it up, I think in our case study, the total purchase price where we stand now, the buyer has decided to pay an upfront consideration of 800 crores, and the most likely payout for the contingent consideration for the both components is 75 crore, both non-financial and the financial metric link payouts. With that, while so far what we've discussed is out and out, the enterprise valuation aspect, how that valuation converts into purchase price, and the objective obviously being value maximization in the mind of buyer and seller. But we all know, several policy changes have taken place in the recent past, and it is becoming very important, and the policy changes have elevated the need for evaluating different structures. So making sure from a tax perspective how these structures lead to value maximization. And for that, I'll invite Vaibhav to share some thoughts.
Vaibhav, just before you start, we have one question from Samudra. In an NR to RR or reverse share transfer deal, whether weight should be given to all valuation methodologies or only DCF. The short answer is that for non-regulatory valuation, it's entirely up to the buyer and seller what valuation methods they use. There is no one method, and at least in my experience, the buyer will go for the method that gives them the lowest valuation, and the seller will go for the method that gives them the highest valuation, and then they'll negotiate it. And so I leave it there. Weber, back to you, please.
Great. Thanks, Aditya. Thanks, Vinay. So I think in terms of M&A transaction structures, the usual understood structures that we all know of are either you acquire shares or you acquire business. Now, that is typically understood, and each has its own separate tax consequences, which we'll go through. But in recent times, what we've seen, and we've been advising on several transactions along these lines, is that if you really combine mergers and demergers, which are traditionally tax neutral ways to structure transactions, which have traditionally been so far looked more as internal restructuring modes to restructure businesses and internal structures, can we really look at introducing a merger demerger kind of a structure into external transactions, and what kind of tax benefit it can introduce? So we'll look at it. We'll look at it through case studies. So just reintroducing the case study that Vinay had introduced earlier. You've got a company which is buying a business X from B company. The net worth of B is 460, whereas the negotiated deal value is 800 with an additional earnout of 100. So the total deal value is 900. And how do you really look at taxes in this entire transaction? What are the various modes? So we'll look at a share acquisition, a slump sale or a business purchase, and a demerger as the ways and modes to structure these transactions, and we'll look at the nuances of each of these. Coming to share acquisition, so the facts of the case really are: A is acquiring shares of B for a consideration of 800 against the book net worth of the shares of B, which is 460. So in effect, A is paying a premium of almost 340 to acquire the shares of B. Now, in a traditional structure, the way it will work is that when A acquires the shares of B, this gets reflected in the books of A on the investment side as an investment in shares at a value of 800, right? The only time it really gives a tax benefit to A is when A will sell these shares. It will get a cost of 800, and anything that it realizes beyond that cost, it pays capital gains tax. Now, what becomes important is that this premium of 340 that has been paid, this is effectively nothing but the value of goodwill that A has paid for B, right? This is a running consumer business. There is a lot of value. There's a lot of goodwill. There's a lot of brand, and hence there's a premium that has been paid. What if through the structure, we reinstated this value, this premium, into the books of A, which gave it a benefit, a tax benefit on an ongoing basis, rather than really waiting for the liquidity event eventually to happen? So one of the ways really to do this is that after you've done the share acquisition, what if you did a legal merger of B and A? And when you did that, what will effectively happen is that the 800 of the amount of on shares that has been paid and the resultant premium that has been paid, that can be reinstated in the books of A in the form of a goodwill. And then the way it will work is that you will be able to have a basis to claim a depreciation on this goodwill, which gives you an offset against your taxable income. So we'll look at this in detail, but purely from a buyer's perspective, Vin, if you could just stay on the previous slide. Purely from a buyer's perspective, I think issue is how do you really get benefit of this premium? The issue also becomes complicated if, in this case, let's say B had tax losses. How do you really ensure that these tax losses continue to be available even after the shares are acquired? Then you've got deeming income provisions under income tax, which are relevant both for the buyer and the seller. And of course, when there are non-residents involved, how do you really look at tax withholding for the buyer? And from a seller's perspective, how do you really look at claiming treaty benefits? So we'll look at each of these in greater detail, moving on from there. From the buyer's perspective, as I said, if you were to really consider a merger of B into A after you've done the share acquisition, it gives you a basis to reinstate the premium paid on shares onto as a goodwill in the books of A. The Supreme Court, in the case of Smith Securities, has held that goodwill created pursuant to an amalgamation is a depreciable asset. There have been several judgments, both at tribunal level, at high court level, pursuant to that, which have upheld, which have really gone on the basis of this Supreme Court judgment and have upheld the claim of depreciation on goodwill created pursuant to a merger. There's been a negative judgment, which was in the case of United Breweries, but there the facts were different. Even just a couple of weeks ago, there has been a positive judgment from the Karnataka High Court in another case, not in the case of United Breweries, but where the arguments taken in United Breweries probably have been overruled by the Karnataka High Court. Coming to business losses, what becomes critical is that in the case of closely held companies, if there are business losses, the tax law provides that if there is a change in shareholding beyond 49% in any particular year, then your losses will lapse. Now, in a deal situation where these tax losses are important because these straight give you a 25-30% tax benefit, in most cases people will not really want these losses to go away, and hence it becomes important how do you really structure these losses, the transaction in a way that you don't end up losing the losses. Moving on from there, uh, yeah. So the interesting part is that this issue around lapse of tax losses does not apply to unabsorbed depreciation, and hence, depending on the facts of each case, the mix between unabsorbed depreciation and the business losses, one will really need to look at how to structure the transactions. Coming on to MAT credit, I think we had a question also on this from one of the audience. The issue here is, the income tax law really is silent on what happens to a MAT credit. Does it get transferred on a merger into the books of the amalgamated company? The law is silent. This is more a matter of precedent and practice. The way it has really been held is that if so long as there is a very clear-cut provision mentioned in your merger scheme, then the judicial precedents have allowed transfer of MAT credit onto the books of the transferee company. Moving on from there, the other important aspect is Section 56, which most of us would have heard of. This is another anti-abuse kind of a provision which has been brought in the income tax law. So the way it works really is that in the event the buyer pays a consideration for shares which is less than the minimum prescribed value under Section 56 read with Rule 11 UA, then if there is a difference, then that difference gets added to the income of the buyer as a deemed income. Now, in our example that we just took, what is happening is while the book net worth of the company is 460, the immovable property that the company owns, the difference between the circle rate and the historical cost or the book value, there is an upside. And the way Section 56 formula works is that if the company whose shares are being exchanged has a property, then the book value of that property will get replaced by the circle rate, and that forms the basis for computing the minimum sale consideration. So accordingly, in our example in the case study, the minimum value comes to 1,000 basis the circle rate value of the immovable property. Against this, the consideration that has been paid, and I'm ignoring earnout for the moment, the consideration that has been paid is an 800, and hence there's a deficit of 200, that there's a 56 exposure on the buyer in this case. We were recently faced with a similar issue again on a real estate transaction where this was a live issue, and again it comes to structuring, and one of the ways to really structure this and get past this is to look at a transaction where you're not really doing a transfer between two shareholders, but you are doing a transaction through the company. So if you could structure this transaction as a buyback or a capital reduction, then that gives you a basis really to get past this entire Section 56 issue on the buyer. The next aspect really is tax withholding. Again, when there are non-resident sellers, the law casts an obligation on the buyer to really withhold tax under Section 195. Now, the issue that comes really is if the seller comes from a treaty-protected country, then how does the entire withholding tax works? There have been a plethora of judgments around how does 195 work? When there are sellers coming from Mauritius or a Singapore, and the Indian tax authorities have not been kind really, where they've held that even with a valid tax residency certificate, you are not eligible for treaty benefit. We saw the Tiger Global ruling a few months ago. We saw AB Mauritius a couple of years ago. So there have been, there have been multiple such judgments that have been coming from the Indian tax authorities. And hence, how do you really look at it? Can we apply for a nil withholding or a lower withholding tax certificate to the income tax department itself, and let the income tax department itself opine on whether you are eligible for a lower withholding? Uh, or the other way to really look at it is, how do you really structure tax indemnities? This becomes important when you've got private equity funds as sellers, because when you've got private equity funds with a limited life, with a limited fund life, do tax indemnities really work? Because tax indemnities will, your fund life will probably end before the time your assessment happens. And hence, is a tax indemnity a very effective way to deal with situations like these? We've been advising on transactions where insurances have come in. The buyer really can take an insurance against its withholding tax obligation, where if there is an adverse judgment from the tax authorities, then you are at least insured and your risks are covered. Moving on to look at the seller's perspective in a share acquisition and a merger. We all know a seller will pay capital gains tax, long-term, short-term, depending on the period of holding. The issue that really comes here is that with this increased surcharge that happened last year in India, if there are individual sellers, and if the transaction value is, the total income is really more than 5 crores, then the effective rate of tax really goes up, because you've got a surcharge of 37%. So if it's a long-term capital gains, the effective tax rate comes to 28.5%, whereas a short-term becomes almost a 43% tax. Now, the issue here really is that if we can structure this well in time, then there could be a basis to look at least lowering the rate of tax, where if instead of the individual being a seller, can you have a corporate seller? Can you have an LLP who can be a seller, where your effective rates of taxes are lower, right? Just the way we looked at Section 56 in the context of the buyer, which is a deeming income provision, we've got 50 CA, which applies on the seller also, where the valuation formula is the same. It is basically, if as a seller you've got consideration which is less than the minimum consideration, then the minimum consideration becomes your deemed consideration, and you pay tax accordingly. So again, issues from a seller become very, very critical, because you might end up paying taxes on something that you've not even earned, right? The last aspect on the seller really is that if you're a non-resident, how do you claim treaty benefits? I just spoke about it in the context of tax withholding certificate, but we are now living in an era of BEPS and multilateral instruments, where availability of treaty benefits has been subjected to a principal purpose test and a limitation of benefits clause. How do you really look at all that? Should we do a proper due diligence in advance to see if there could be challenges around treaty positions? So I think from a tax perspective, that becomes extremely important. Moving on from there, the second mode of really doing a transaction could be in the form of business acquisition or a slump sale. Here, again, there are several issues from a buyer perspective as well as a seller's perspective, and we can just jump into it in the next slide, Vinay. So from a buyer's perspective, here is where a lot of valuation will become important, because if you've paid a premium, which we saw in our case study, the premium of 340, how when the buyer acquires the assets onto its books, how does it account for this 340? Where does it record this 340? And you will need a purchase price allocation to be done, where you'll have a valuation report on the various assets, which are which may be both tangible and intangible. And I'm sure Aviral and Vinay will cover this in detail in the later part of the presentation. But a large part of your purchase price gets allocated to tangible, intangible assets. How do you really look at deductibility and depreciability of these assets? Let us say you record various intangible assets. what becomes really important is, while from a purchase price perspective, you may end up recording a number of intangibles, do all these intangibles really give you a depreciable base which is allowed under tax? Here again, there are several judgments. The general ratio that has really been held is that as long as the intangible assets that you've recorded, they are in the nature of business and commercial rights that give you an enduring economic benefit, you should be eligible to claim depreciation on it. There is this section 32 under the Indian Income Tax Act, which covers this. There are, the Supreme Court, at least in the case of Smith Securities, had held that goodwill also is in the nature of a business or commercial right, which gives you economic benefit. I think one important in a recent transaction, what we've seen is that this was again a real estate transaction where a large part of the entire consideration was being allocated to leasehold rights, because there was a long-term leasehold property which was getting transferred as part of the business. The precedents here do not support depreciation on leasehold rights. The courts have held that leasehold rights are a right in immovable property, and hence they do not really qualify as an intangible asset which is eligible for depreciation. You'll have various other intangibles in the form of customer lists, customer relationships. Again, the test really is that is there a right that you have over that asset which grants you economic benefit. Coming to tax losses and MAT credit on the slump sale, here the issue really is that because this is a business transfer which is not tax neutral under income tax law, the tax losses do not really travel along with the business. Tax losses are left behind in the transferor entity, and similarly the MAT credit also is left behind in the transferor entity. Coming to deeming income provisions, which is section 56. Here, the issue is, and very interestingly, section 56 covers receipt of property, and property is defined to mean immovable property, shared securities, jewelry, all that. What it doesn't cover is a business as a whole. And hence, one view that can be really taken is that when a business as a whole is being transferred, then your deeming income provisions in the section 56 do not apply. Having said that, I think what we need to be really careful is that if you are transferring something which is nothing but land and building, then you will need to really factor in the risk of litigation there.
So this is where I just want to, look at a clarification. So what you're saying is that, let's say you have, a 20-year-old factory fully running, it's been constructed, manufacturing, everything is going, and that is sold as a sump and sale, as a going concern business. More likely than not, you should be able to argue that there is no point reevaluating the land and under Section 56, because it is intrinsically connected to the business. It's not like that you can sell the land off or this as a separate asset on the book. It is directly connected in with the business itself.
That's right, Aditya. And even from a valuation perspective, I'm sure Aviral and Vinay will confirm that when you go about valuing this business, you will not really value the land separately, because land really forms part of the entire business value.
What happens if you, let's say, have a 10-acre land parcel, right? And you want it to have future expansion. You've built out 5 acres. There is still the provision to build out 5 more, and you're holding it in reserve for future expansion. A acerbic tax authority might make the argument that that's very nice. Those 5 acres we consider, as part of the going concern, but those other 5, expansion might happen in the future, but it's not now. That you please apply Section 56.
No, I agree with you, Aditya, and very, very valid point. I think that is a risk that one can't ignore. But the way I will really look at it is that as long as one can really justify that the majority part of the consideration is for the running business, and this 5-acre land is just incidental to it, right? Then you still have a basis to say that what I've sold is business as a whole.
So,
but let us say you've got a case where while the total consideration is 100, out of that 180 belongs to this surplus land. then you're not in such a good position.
No, fair enough. So I think the key word which you use is incidental, right? It just happens to be there. Yes, it's part of the deal. Yes, it might be valuable, but this isn't a land grab.
That's right.
The focus is on the entire business, and yes, some land may or may not come with it. That's very nice, but the focus is on the business. It's when you have like Air India buildings that are going where the building is more valuable than the company that, that I think you might have issues.
I agree.
Please go ahead, Vaibhav.
Great. So moving on, Vinay. From a seller's perspective, again, from a capital gains tax point of view, the issue really is that when the company sells the business, capital gains tax arises here. Again, the period of holding depends on the period for which you've held the business. Short term, long term, 36 months is the guideline here. You don't get indexation benefit. The cost that you get as an offset is the net worth of the undertaking, which is computed as per the formula prescribed under Section 50B. With the formula basically takes you to the income tax written down value of the assets that are depreciable, the book value of the assets which are not depreciable, and you deduct the book value of your liabilities. So really, so that forms the net worth of the undertaking, which is your cost. Again, on deeming income provisions, Section 50CA and Section 50C, these apply when you are selling either property or you are selling shares. The view that is taken is that if you are selling a business, you are not hit by deeming income provisions. The other really interesting aspect that one can consider as a seller is that instead of really doing a slump sale, can we really look at doing a slump exchange? And the difference really is that in a slump sale, while the consideration is in the form of cash, in a slump exchange, the consideration assumes the form of securities, shares, debentures, whatever. And here you've got judicial precedents, Bombay High Court and a recent, I believe, Chennai High Court, which have held that when you do a slump exchange, it is not chargeable to tax because what Section 50B, which is the specific provision which taxes slump sale, that covers only a sale and not an exchange. They've tried to distinguish between an exchange and a sale, and that potentially opens up interesting possibilities to structure transactions where the seller can really take up a no tax position. Again, extremely litigious, but I believe there is a reasonable basis to really consider this seriously. The last aspect from a seller's perspective really is what happens when the net worth of the business that you have transferred is negative. And when I say net worth, this is net worth computed as per Section 50B. Now, the way the formula for capital gains works is that you've got a consideration and you deduct net worth from it. That gives you your capital gains. Now, in a situation where your net worth is negative, the debate really is that do you add the negative net worth onto your consideration and hence it gets added to your capital gains? Here again, judgments are varied. There are both positive and negative judgments, and hence all the more need to really be careful about situations like these. Moving on, we'll cover demerger as another mode to do a transaction, and again, a demerger throws up very, very interesting possibilities. So, in place of really doing the transaction as a slump sale, can we really look at doing a demerger where A company, in our case study, acquires the business from B company by way of a demerger, and as consideration, A company can just issue shares to the shareholders of B. Now, here again, like a merger, there are issues around how do you, have tax deductibility of the premium that you've paid on the demerger. How do business losses happen? From a seller's perspective, again, what do you have to do? What you're demerging, is that an undertaking? How do you transfer liabilities? All those things, and we'll just quickly look at these in a bit more detail. Now, again, on the premium that has been paid on the deal, just like merger, the position that one can really take is that even on a demerger, when shares get issued at fair value, the resultant the recording that gets done by the transferee company, a company in our case, really goes to a goodwill. And there has been a recent Mumbai tribunal judgment in the case of Classic Stripes, which has allowed depreciation on goodwill created pursuant to a demerger. So, as opposed to a slump sale where you are doing a purchase price allocation, really allocating a lot of your premiums that you've paid on to various intangible assets, and then getting on to the debate of really which part of which intangible asset is depreciable, which asset is not depreciable. If you do a demerger and basically the entire value goes to goodwill, there are judgments in favor which allow you the depreciation on the entire goodwill created. In terms of tax losses, if there are tax losses in the company which is selling its business, demerger gives you a basis to migrate those tax losses to the transferee company. So unlike a slump sale where we just saw that the tax losses will remain with the transferor company, in a demerger, the losses which are relatable to the business being transferred travel to the transferee company. And the transferee company has the ability to claim them for the unexpired period, for the remaining life of those losses. Again, coming on MAT credit, as I said, in the context of a merger, again, there is no clear mention in the income tax code on moving MAT credit on demerger. The principle remains the same. Judicial precedents are there if there is an entire business moving and your scheme of demerger clearly specifies that MAT credit will move. Judicial precedents have upheld that provision. In the interest of time, I will probably skip the delisting part, but just very quickly, there in the recent times there have been several schemes where through a demerger scheme, delisting has been done without really having to follow the entire delisting guidelines, reverse book build process, etc. Again, very fact specific. We may just move on to the next section, Vinay.
If you'd like to speak about it, let's speak. I think the consensus I'm getting from our panelists and audience is that we still have half our slide deck to go, and I don't want to rush through any of these slides. And what we can do is we can sort of break at maybe the end of 15 minutes or so, and then give sort of a part two, because this we have just gotten started. And I think we still have, to my estimation, 30, 60 very, very important slides, which are far more interesting than I've seen most of these workshops and webinars cover. So I think we'll end in a few slides today, take a pause. This will also give our audience a chance, and we'll get the recording out to them to slowly go back and come back next time with questions.
Sure. Sure, that sounds good. So coming back, Vinay, if you could just come back to the previous slide, I'll cover the
But this is a very important thing, and I don't want to skip it because it's a huge thing to delist a company in India.
No, absolutely, I agree with you. So what has happened is that, so the new company law, so I'll just tell you a brief on the background of this. So the new company law, which is the Companies Act 2013, we still call it the new law, even though it's now 7 years old, that had brought in a provision which allowed a listed company to really merge into an unlisted company, and the unlisted company really remaining unlisted. So with the unlike in the previous law where if a listed company merged into an unlisted company, the unlisted company had to automatically get listed. Now the company law really provides and enables an unlisted company to remain unlisted even after taking over the business or merging into from a listed company. Now, what happens is that, in the context of a demerger, and there have been several schemes around this, what we could really look at doing is that, let us say a listed company wants to take private a part of its business. The possibility that comes up is that either you really subsidiarize that business, which means you put it into 100% subsidiary through a business transfer, or the other way to look at it could be that if you want to do it through a tax neutral process, then you could really look at demerging that business undertaking into an unlisted company, and the unlisted company really remaining unlisted and not getting listed. You could choose to issue equity shares, you could choose to issue a redeemable pref share, but the underlying principle is that whatever share you issue, you will not list. Now, the issue that comes up here is that from a SEBI's perspective, all that SEBI will care about is that whether the public shareholders are getting a fair deal or not. And hence, what is important is that you will need to demonstrate that the price that has been paid basis the share swap, that's a fair price. And there is an exit option which has been provided to the public shareholders. It shouldn't so happen that the public shareholders really don't have any option to get out and they are stuck with an unlisted equity share which has no liquidity.
Is there a formula or a consideration for premium for those exited shareholders?
No, Aditya. So there is no formula again. It really depends.
Let me put it perhaps more concretely. Assuming that there is a deal where we are looking at this is part of an M&A transaction, so to speak. The exiting shareholders have to be treated on par with the new acquirer. From the old, I mean, the minority rights are equivalent to that of the majority who's selling off. Is that a consistent rule? If you have holdouts who are asking for more, can they sort of scuttle the deal?
Oh yes, absolutely. I think so. It is extremely critical to establish that fairness. You should not be seen as really shortchanging public shareholders. I think that is a very, very clearly established principle from SEBI. SEBI looks at these schemes very closely. So this is a very close scrutiny that happens here.
And is there a percentage at which the risk is higher? 75% already taken versus 90% taken, 5% outstanding, 3%, or it doesn't matter. It doesn't matter what's the percentage of minority shareholders left.
No, absolutely. So the larger the percentage of minority shareholders, your risks are higher because typically speaking, you will have to have a majority of minority shareholders approval in schemes like these, and hence the larger your minority shareholders, your risks tend to go higher.
And just to remind everybody, including me, is there a consistent definition of a minority shareholder in this?
So minority shareholder, Aditya, really is every shareholder who is classified as part of the public under the SEBI regulations.
But is there a percentage?
Is not part of the promoter and promoter group.
So as long as you're not part of the promoter. So it's not that I have 10%, but I'm a great institutional guy with billions of dollars. I'm on par with the guy who owns maybe 0.5% and is an individual shareholder.
The difference it will make is that the larger percentage you have, your ability to influence the decision really goes up.
But you are not treated separately. So there is no judgment on either the expertise or the professionalism of the shareholder. A minority is a minority regardless of who's holding those shares. There isn't a distinguishment in which some countries do between a professional shareholder versus a classic retail shareholder. The rights are the same.
That's right. That's right.
Perfect.
Great. Moving on, Vinay. Yeah. So from a seller's perspective, what becomes important in a demerger is one is what you demerge, does it really satisfy the undertaking test? Now you've got section 2, subsection 19AA, which really talks about conditions of a tax neutral demerger. And it defines an undertaking really to say that an undertaking is a business activity which is taken as a whole. So the issue that comes up here really is that as long as you are demerging an entire business activity, you are okay. The undertaking does not include individual assets and individual liabilities which do not form a business activity. The debate and the controversy starts coming up when the businesses that you are demerging is, while you may call it a business, it is effectively a group of assets. And one classic example is in the context of a demerger by Grasim of its financial services business into Aditya Birla Financial Services. There's been this issue that has been rigged up where the validity of the undertaking itself has been questioned by the tax department. So the contention there really is that what you are what you've demerged really is shares and securities and not a business, and hence this is not a tax neutral demerger. Again, becomes important. I could probably extend the same argument to a business which is nothing but real estate, and can a tax officer come and say that what you've demerged is property, is land, and hence I will not treat it as a business. So in some very pertinent issues that have started coming up here in recent times, and hence that just signifies how critical and important this issue is and how careful we need to be. We could move on to the next slide, Vinay. The other aspect is that in a demerger, what we are doing is we are demerging a business undertaking. Does that really require that the company which is doing the demerger, which is the seller, does it need to have one more business undertaking, which will be the remaining business? Now, purely if you look at the income tax law, it does not require, or it does not presuppose existence of at least two business undertakings for a demerger to happen. The issue is, can a tax officer really allege that when you did a demerger of your only business, is there a tax benefit that you derived through that demerger? And we'll cover this in the context of GAR, but I'll just introduce that concept here. The officer's allegation really will be, what is the tax benefit that you've derived by doing a demerger instead of doing a merger? Which is where I think we'll need to have very sound commercial basis to be able to do this demerger. This sound commercial basis could be as simple an argument like, we need a company to really start another business, and we demonstrate that we've started another business post the demerger. And these are things which are more business related, but have a lot of tax consequences. The other aspect really is that when you issue shares to the shareholders pursuant to a demerger, how does that work? Now, in our case study where we are, company B is demerging its business into company A, and the shareholders of company B are getting shares of company A. What happens? How do they get a cash exit? Right? Now, cash exit could be, so let's say the company A issued a redeemable preference share to the shareholders of company B, and this preference share can get redeemed. Can the tax officer really argue that what you've done is effectively paid cash to the shareholders of company B and not shares, and hence I will want to really challenge the tax neutrality of the demerger? Because one of the conditions for a tax neutral demerger is that the shareholders of the demerged company, which is company B, will get shares in company A on a proportionate basis. Now, while in form you're really meeting that condition, but what if you just issue shares on day one, the next day you redeem those shares? Are you in substance meeting that condition? And that becomes extremely important. The second aspect really is that another condition of a tax neutral demerger is that at least 75% of the shareholders of the demerged company have to become shareholders in the resulting company. Now, what happens to the balance 25%? What if we pay a cash exit to the 25% shareholders and we issue shares to 75%? Is that sufficient compliance with the tax neutrality condition? Again, these are issues which are, litigious. Will need careful examination in each case, but extremely pertinent issues. With this, I will hand over to Aviral, or
I think, as agreed by all of us and our poor audience, we're going to take a pause here, and I think this is sort of speaks to the complexity of it and how important it is for us to go very carefully through this. So I think, with everyone's permission, what we're going to do is we're going to break this out into two parts. So the first part one and part two we've covered. We'll try and get this recording up as soon as possible so you can view it, you can share it with your colleagues and all of it. And we'll arrange for another date, perhaps in a week or so, where we can look at part B of this. Because we've only sort of hit 36 slides, which is our middle point of this. There's still a lot we need to talk about in terms of the mechanics beyond the structures on the pre-deal purchases, the price allocations, really trying to figure out the nuts and bolts of this. And so far we've only talked at a very macro view. So with the permission of my panelists and our audience who sort of hung on to us well beyond our stated timelines, I think we should have seen the writing on the wall. I'll close on this, and we'll have the recording to you. Whoever has used the CII form to sign up, if you haven't, please go and have a look at it, or we'll also email it to you if you have signed into Zoom using your email address. You can also find this at our CII state webinar system. I will post the link for you in the chat box, and we'll try to get this up and running in the next 3 to 5 days. And meanwhile, hopefully we will have a new date where we can do part B. I am really grateful for all the panelists for the hard work they've all put in. We've had something like 100 plus attendees at any one given point going in and out on our Zoom. We've had another 150 plus on YouTube, and of course with lots of questions on LinkedIn. We will get through all your questions in part B. Please send them in advance if you'd like, so at least we are all aware of what those questions are, and we might spend maybe 5 minutes in part B just recapping through part A, so we are all on the same page. With that, my deepest thanks to our panelists, to all the teams at Dhruva and Duff and Phelps who really helped put our case studies and do it till the last bit and slide and get all the numbers right. And I'm very excited for part B, because you'll actually see us then looking and taking this deal down through the nuts and bolts and really showing how we go from a very, very high level talk about what valuation should be and how we should do structuring, to actually going and making those decisions and seeing the consequences of that. Thank you very much. And I look forward to seeing everybody, hopefully next week or the week after that, the moment we can get something on the schedule in.
Thank you.
Thank you.